It is a damp and gloomy Wednesday morning in the city of Toronto as we try to figure out what the holiday season will bring this year as we learn how to deal with surging cases of the coronavirus. My name is Bob Simpson, host for the series of webinars and podcasts. Welcome to the Huddle for today, Wednesday, November the 25th. This is our first pre-recorded session as we change the format from live and recorded to recorded and distributed as both a webinar and a podcast. This gives you greater ability to participate on your terms when you have the time and through your format of choice. We will be conducting live sessions in the usual Thursday afternoon at 3 p.m. time spot on either the first or second Thursday following the end of a quarter. To discuss investment markets and performance and to allow you to attend and to ask questions. At Wealth and Portfolio Stewards, we believe that it's very important that you are engaged in your wealth and investment planning activities. Even though we are discretionary managers, we understand the importance of communicating effectively as we help you on your path to financial freedom and family harmony. Thanks for taking the time from your busy schedule to join us on today's call. Today is a virtual due diligence roundtable. At Portfolio Stewards, we have been investing in Trez with Trez Capital for almost 7 years. Over that period, we've invited today's guest to discuss Trez in several of our regular due diligence calls with our investment committee, as one of our goals for 2020 has been to improve transparency and to better engage our clients in their investment strategies. We've been using the Huddle as a medium to let clients look behind the curtain and to see what we see and learn what we learn when we do our due diligence calls. There's no better way to learn about an investment to get the inside view from somebody who sits in meetings in which investments are discussed and decisions are made about everything, both macro and micro, both big and small decisions. So number one, if you are watching the webinar, you will see a slide that shows join the Huddle. If you wish to view previous recordings, just go to portfoliostewards.ca and click on join the Huddle and you will be able to access to some of the past sessions that we've done. Now joining Paul Tyers, Managing Director and Portfolio Manager at Wealth Stewards and Portfolio Stewards, and myself is today's guest, Vikram Rajakapolan, Senior VP and Head of Retail Markets for Trez Capital. Welcome, gentlemen, and thank you for your time. Now let me set the rules for today's discussion. Number one, always speak plain English. No industry slang or jargon, just plain English so that our listeners can understand what the heck we're talking about here today. Also try to keep complexity to a minimum. We're in an industry with a huge amount of complexity and we want to keep it simple for our listeners. Our goal is to explain an investment concept so that our listeners walk away feeling comfortable with the investment that we're discussing and determining whether it's appropriate for them and not just like they've attended a sales presentation. Also remember that our goal is to share information and try to keep it fairly concise, and we follow a simple question and answer format. So Vikram, are you ready to take the Huddle's due diligence hot seat? And if so, let's buckle up and let's get at it. So let's start with Paul. Paul, take it away with question number one for Vikram.
Good morning, Vikram.
Good morning, Paul.
We've known each other for a long time, and Portfolio Stewards has invested our client money for many years now, primarily in the Trez Capital Yield Fund. Now, your marketing materials describe this fund as follows: a diversified, balanced, short-term commercial mortgage strategy. And it says that This particular fund invests across the capital stack, including first and second mortgage positions and blanket mortgages, sometimes secured by multiple properties. Loans may be secured in Canada or the United States, and the primary objective is to preserve capital while generating an attractive and stable rate of interest income for unit holders. Now that's quite a mouthful, but I wonder if you could get really direct with us and tell us what that practically means in your own words.
Thank you, Paul, and again, happy to be on this call with you. Yes, we have known each other for a long time. I think I can't believe it. We're already talking about 6-7 years now. But I'll make a little bit of a correction off the first statement. For most of your clients, you're mostly in a fund that is invested 100% in our U.S. mortgages. To put it very simply for your clients, Trez is an underwriter of short-term bridge mortgages. Short-term being 6 months on the low end, 36 months on the high end, where people come to us for short-term financing to take what is a non-bankable loan, perhaps not completely stabilized, where a big developer can go after 2 years or 3 years and go get a very stable lower interest rate loan at the bank for 5 to 10 years. So we're a short-term lender. Our head office is in Vancouver. We have an office here in Toronto, but we also have an office in Dallas and Florida and Atlanta, which is where most of the mortgages for our U.S. fund is originated, specifically in Texas. And so what we do, and we take, but because they're commercial type mortgages, but we focus on residential, and that is not lending on someone's individual home, but we lend on multi-residential, be that apartments, be that single family, single home lot development loans in the state of Texas and Florida. And all of these short-term loans are put inside a fund, and they're always turning over as loans are getting paid off and new loans are being put in. And your investors at the end of the day get the interest generated from these loans on a monthly basis, net of all the associated fees. And so for years, I think what your clients have been accustomed to is stable monthly distributions as over the course of the year, plus a bonus distribution at the end of the end. So all our, again, mortgages means everything is the collateral, or what it's backed by, is real estate, and we are the financiers of that real estate in the U.S. We're big believers of having offices in the U.S. close to the loans in case something does go wrong, and invariably things do go wrong, and I'm sure we'll talk about a few risks. But that is in essence what a mortgage pool is that it allows an investor to invest in a diversified basket of these mortgages. In this case, this particular pool is roughly $900 million in size, diversified over 100 plus mortgages, where you're getting that stability of income. And while 1 or 2 mortgages, something might go wrong, it doesn't really affect the investor in the grand scheme of things. So it allows them diversification across a pool of mortgages that we underwrite, go through credit committee, and eventually for the investor, it's the interest that is generated from those mortgages that they see in their return. And again, the fund is structured in a way that it's stable. As a client, you buy it at a $10 unit value. When you want to redeem, you redeem at a $10 unit value, and everything in between is just the interest that you generate. So very much a fixed income type instrument for your investors.
Well, thank you, Vikram. And I want to emphasize, I think one of the key points that you drew out there, but I want to emphasize it again, is the leaning towards multi-residential properties. Certainly during a COVID period, we've been asking people, what does commercial mortgages mean? I mean, there's a lot of empty office buildings around. Yeah. You've given them the assurance that in the case of Trez, it's predominantly against multi-residential properties. Is that still the case?
That is still the case. And you are right, Paul. Commercial is a bit of a tough term because if we said we were residential, most people would assume that's to someone's house. If we say commercial, I think people gravitate towards office. And what people don't realize is commercial in the real estate jargon is really meant to say anything that is in between, anything that is not lending to someone's single home. And so we focus, and we start to focus a lot more in 2018, where we kind of stopped lending to retail and hospitality and office, and really focused on two asset classes. One was multi-residential apartments. So that is affordable housing in the southeast of the United States, which is, we like to call it the Smile States, that starts at Texas and goes all the way in the southeast of the United States. And something called, and again, not a lot of your investors would know this intimately, but something called short-term lot development loans. Before you have a house, you have to put it on a lot. And big lot developers, specifically in the state of Texas, that has seen an incredible boom in housing because of being business friendly and the gravitation of companies. There's been a huge housing shortage in the state of Texas. So big lot developers will come to us for financing to get, say, pick a number, 200-300 lots developed so that they can sell it to home builders that can build homes for people to live in. It is an asset class that is not a lot more non-cyclical, meaning they're not as economically sensitive as, say, an office or retail or hospitality. And if you do it in the right markets where there is demand for housing, as there is in the southeast of the United States, that has kept us in very good stead even through 2020.
Well, just a final comment on that. It was fortuitous that there was a bit of a switch in 2018, and I take it in part that was due to supply and demand.
It was that, Paul, but we don't have a crystal ball. But in 2018, and as you know, Paul, you've been around pretty much, since sort of the beginning of our genesis, from a only Canadian mortgage lender to sort of Canada and the U.S. and specifically in Texas and the Southeast, where we've always looked at the residential. But in 18 as well, what we heard from a lot of smart economists and people that we use was to expect some kind of slowdown in the economy in 2020. I think that was general consensus. Now, again, no one talked about a global pandemic. No one talked about 25% GDP contraction or anything like that. But once we start to get that into our head, we decided to move away from the more economically sensitive real estate. And again, that is office, that is retail, that is hospitality, and really turn our focus to residential. And as you'll see on our fund fact sheets, we are north of 85 to 90%, specifically in that fund, in some residential backed real estate mortgages.
So Vikram, let's next turn and take a look at the bottom line. How has the fund performed since inception, especially as financial markets have dealt with COVID-19? And part two, what do you think the performance will look like in 2021?
Thank you, Bob. So the performance of the fund over the last few years has been incredibly consistent. That is what we want to deliver to clients. Initially, as you will see in this bar chart, we were making very high returns when this started. And a part of that was we started lending in the US right post the financial crisis. For those that might follow what was going on post the financial crisis in the US, there were heavy banking regulations. And so really there was such a lack of capital, and Trez really was opportunistic in getting into the markets in Texas at the time when there was such a huge demand that people were willing to pay us at the point where we outsized rates for the risk that we were taking. And that's where you sort of see that 10 to 12%. Since then, over the last 3 or 4 years, we've kind of evened out here at about a 7.5 to maybe 8%. The one thing all your investors have to realize about a private mortgage fund, there is a maximum return you can get. This is not something that you wake up one day and we can do 15, 16. There's so much people will borrow, a rate at which people will borrow from us. So if you look at it today, with the markets being as strong between 2014 and let's just say pre-COVID, you were in a situation where the market normalized and our big boards said, okay, you know what, the market is de-thawed a little bit, so instead of paying you 12%, we'll pay you 10% on some of these loans, and quite frankly, there's always that sort of reversion to an average rate, if that's the word, and so now we've sort of settled in here at that 7.5 to 8% return consistently over the last 3 or 4 years. Bob, did you want me to get into the COVID, how we've dealt with it since March now?
Yeah, that'd be awesome.
Yeah, and so when COVID hit for us, it was a very interesting time because no firm has dealt with a global pandemic. And when you're talking about shutting down the economy, when you're talking about what is essential services, one of the reasons we went into this asset class, as I alluded to Paul earlier, it was more non-cyclical, but it was, or more economically not as sensitive. But that's for normalized, as I call, recession. It wasn't meant for where everyone was staying at home, businesses shutting down, and we didn't have any foresight. So in March, there was a real concern internally for us how short-term lot development, how housing would react to a global pandemic. As some of your clients would know, that we halted our funds to redemptions in March, and a part of that was not knowing to get the pay downs that we were so accustomed to, whether or not the markets would be as strong as we thought it was going to, and watching investor capital leave while you're still trying to manage the portfolio was a prudent thing to do while still maintaining the distributions. Through that entire period, we never cut our distributions, because what became abundantly clear very quickly, and I think oddly enough, as we talked here in November, is real estate has been very, very strong. I mean, 2008 was a different crisis than COVID. 2008 was led by real estate. What I think most people are saying is that this economic recovery might be led by real estate coming out of it. People are, and I'll talk about the trends that we see, but our portfolio not only maintained and was very strong, but in many cases, when we looked in June and July, might have been stronger than it was pre-COVID. And again, when I talk about the trends, I think your investors will see why that is. The gravitation to suburbs, the demand for bigger homes, new builds versus existing, all of those good things. So we sort of opened up the funds in the summer when we were more confident about the marketplace. And we've been very pleasantly surprised how resilient and how strong our thesis was. Again, it wasn't stress tested for a pandemic. I think if I said that, no one would believe me anyway, but it wasn't stress tested for any of this. But we have been very happy with the way things have panned out. And to your question, how do we look at the future? It's interesting. We see a lot of opportunity right now. Again, real estate is based on the three-legged stool: population growth, employment growth, and interest rates. I think everyone here understands where interest rates are and and for the first time in at least my career, I think the Federal Reserve has sort of said interest rates are going to stay here for the next 2 years. So really that in itself is a boon for real estate. But when you deal in the markets of Texas and Florida, and for those that don't know, Texas and Florida are both zero state income tax. So there's a huge tax advantage to living in Texas. There's the weather component. There's all sorts of things that lead companies to move over to Texas. So Texas and Florida and the Southeast, Georgia you include in that, has had a huge population boom, a huge employment boom, which leads to a need for housing. And that looks to continue. There's an undersupply that has happened that continues to be there today. And that demand and supply gap, Paul, that you talked about, while it came a little the demand and supply metrics were actually coming closer in 2019. What you're seeing now during COVID is that gap is actually widening, and where there's more demand than there's supply, which is good for us. On the flip side, though, on the return side, we might get a little bit of an uptick on returns because, again, there's not as much capital in the market, given the banks are not doing as well, given the fact other private lenders are struggling. But that's not going to stay on for much longer. I think as we talk today, we've gone through 3 Mondays in a row where a vaccine has been talked about. I think that is going to mean that going into next year, we're doing well. Those that are doing well, capital will come back in the market. It will become a competitive marketplace. And so these returns that you're seeing today are probably going to be the returns going forward, bar any hiccups along the way.
Well, Vikram, I wanted to just really congratulate your firm for the caution with COVID. And yes, it might have been a little uncomfortable for a few people who wanted to get some capital out, but you certainly weren't alone in gating funds, and yet you were one of the first of the firms that we work with, at least, that was really to say, now it's time that we can actually remove that gating. So in these unusual times, I think that was handled well. One of the questions that I have is always these days, discussion about fees is warranted.
Yes.
And I think when people look at mortgage funds, we would see that your fees were at the higher end of most fixed income funds, even some mortgage funds. I'm aware from my banking days that when you're doing some of the construction mortgage business, the people aren't used to those fees. Can you just speak to that as compared to maybe the spectrum of fees that would be seen in other fixed income types of funds or pools?
Yeah, and thank you, Paul. Like for the 8 years I've been at Trez, I've asked that question. I think where there's misconception, and it comes from us as well, as the word we have in there is fund. So we're looked at as other funds. I try to tell investors, when you're buying into Trez Capital Yield US, you're not buying a fund, you're buying a business, right? And we're not trading Apple stock, we're not buying a bond that we can sell. There's a lot of infrastructure that goes into it. And this might not mean a lot to your clients, but we're $4 billion and we have 100 of employees, $4 billion of assets. It's a very laborious and capital intensive industry that requires credit underwriting, that requires offices in both Texas and Florida, Vancouver, Toronto, to be close to the loans. And the word I will use, and I'm sorry to get technical, it's not scalable, i.e. the more money you have doesn't mean that one underwriter can do 1,000 mortgages. For every 20 or 30 new mortgages that you do, you have to hire another underwriter. You have to hire more infrastructure. You have to hire more more credit officers. You have to beef up your offices because you have to go see the loans all the time. I mean, once you underwrite a loan, you just don't leave it there to be had. So the fees are really a buying into a mortgage business that really doesn't have much in terms of comparison to a fixed income fund. You don't get to have a lot of buyer's remorse, right? And in a fixed income fund, you can make a purchase and then maybe 2 months later you think it's a wrong buy and you sell it, right? We don't have that luxury, right? When we underwrite a loan, we're in it. We have to ensure that if something goes wrong, we have the ability to take over. So we have to have a takeover team. So you're really buying into Trez, not the fund. You're buying into our infrastructure, our offices. And I think when you look, and again, to maintain that consistency, I would assume post-COVID, Paul, you can correct me if I'm wrong, I think we'll get less questions around our fees because I think people understand the importance that we had, just even having our office infrastructure. I tell you, think about this. The Canadian-US border was closed through COVID. If we didn't have the US infrastructure, who was going to go see our loans, right? A lot of Canadian firms have gone into the US because they know what we know, that the US is a much bigger market, much more fractured, and they can get higher returns. But we were really lucky in having those people on the ground being able to travel and see the loans, where a lot of Canadian firms couldn't travel, right? The borders were closed. So maybe that's a bit of a long-winded question answer, but really I get down to you're not buying a fund, you're buying into the Trez Capital business and its and infrastructure. And I think in that regard, the fees are very normal in this space.
And I think, Vic, if I could just add one thing, is that the returns that you've shown are after the fees
Yes.
as well.
Yes.
So when we get a pretty significant incremental return after fees as compared to, let's say, a bond or even mini mortgage funds, at the end of the day, it's really the net return that counts. So thank you for that detailed explanation. I'll turn it over to Bob now.
Yeah, and Vic, I just, along the same lines, I just want to touch a little bit more on a couple things. Number one, it seems to me, is based on your model, that one of your great concerns during this period would be mortgage payment collection.
Yes.
What was your experience on mortgage payment collection during, and still going on? Where do you stand?
So, I'll go back to March. So to give everyone the inside track, we as a firm, we deal with very well capitalized borrowers. So as a firm, we don't deal with individuals. Our average net worth of our borrowers or corporations are somewhere in the $150 to $500 million range in the US. So we know people who can go into their pockets. Initially, what will always happen when you hear about mortgage deferrals and this and giving some sort of freebie, your boards are going to test you, right? Your boards are going to test you, and they're going to ask the question: are you going to defer? Are you not? We made a point of saying at that time we took the same strategy we took on 08, which was leaning on our boards a little bit more, saying no, we are not in a position. We need the paybacks. We are halted right now. That's a part of it, and is to unhalt and to get our investors the capital that they so want. And that requires all of you to pay us back. And we know you can. And that is the advantage of dealing with well-capitalized boards. On the second side, we look at it and say, are you really struggling? And when you looked at the data coming out in April, they weren't struggling. Home sales were record. And again, our home builders in the US were posting record profits, some of them that we were dealing with as the payment activity in the homes were selling. So while in the first sort of end of March, beginning of April, we were very concerned because we were getting questions and people were sort of deferring. By the time we sort of put our strategy down and said we were not accepting it, we really saw very little in terms of deferral. Maybe I would say give and take 5 or 6 loans globally at Trez among our 300 or 350 loans we have at Trez. In the US specifically, Bob, we had no deferrals that we had to give due to COVID. And that was really because, again, our loans, predominantly in Texas in the lot development space, is based on the fact of the strength of the home builder. If the home builder is buying the lots, then the lot developer can pay us back our loan. And if it looked like the home builder was buying and the home builder said, the big one said, we have no problem buying your lot, there was no rationale for us to defer payments. And we haven't really seen any of that to this day. If anything, we start to see prepayments. And that was what was shocking. Because we were leaning on our borrowers, they said, that's fine. We can get financing somewhere else. And that was a risk we took too, was we had to thread a fine line between being aggressive in terms of prepayments, but at the same time, understanding it was a pandemic and that some things were outside of the borrower's control, and we needed to ensure that we maintained our borrower relationships, which I think we've done a pretty good job on both ends. We did in 08, for your viewers, in 08, we lost nearly 50% of our borrowers because we were so hard on them in the 08 crisis. We said, no go, we want our money back. And we really did burn some bridges with borrowers in 08. There was none of that this time around because, again, their own individual strength was pretty good.
Right now, but even with that positive news that you saw and the positive trends, you still gated the fund.
Yes.
And gating the fund is something that shakes investor confidence.
For sure.
Can you just explain, talk a bit about what gating is, why you did it, and such, please?
Yeah. So In any private fund, again, our underlying assets are mortgages. And as I said earlier, our average length of our mortgages is about 1.5 years. As many of your investors know, on any given day, you can take your money with 30 days notice. So at times there's going to be an incongruency between how we underwrite and the liquidity of the fund. But in most cases, it's not a big deal because we're getting so much prepayment activity. We're incredibly liquid. I'll run everyone through something that I didn't talk about. At the beginning of March, we stopped lending money. I remember when our CEO, Morley Green, and the credit committee sent out a memo saying, we don't know what this global pandemic is all about, and we need to gate our funds. We need to stop lending. At the same time, and I don't fault any investor in this, we start to get a high level of redemption activity, i.e. people who wanted to pull out their money. And of course, I know March seems like distant memory, but there was a lot of panic, right? I mean, people didn't know what the world was going to do, how it was going to affect real estate, and they wanted out. So you couple that with our number one priority is capital preservation, our $10 unit value, and maintaining our distributions, because a lot of people depend on our monthly distributions for income. Those were our number one and two priority. And so in order to meet those two obligations of our monthly distribution, as well as ensuring capital preservation, we have the notion of gating our fund. The gating of the fund is done for the investor's benefit. It doesn't seem that way at the time, and I understand it. But looking in hindsight, I think most investors will realize if we hadn't done it, we would have been in a lot worse situation today than we are. Because to see that much of capital go out, you don't know if you can maintain your loan obligations. You don't know who else wants to redeem out of the funds, and you needed to stabilize investor sentiment and really see what was going, how the marketplace was doing. As we saw prepayment, to your previous question, as we start to see a lack of deferrals and everyone paying us back, and we were shoring up capital, and then suddenly investors start to say, we don't want our money. You know what? We get it. And as you know, Paul, for portfolio, for you as a fiduciary of your clients' money, we keep you in touch with weekly calls. We decide to do weekly calls with you and others to ensure that everyone understood what was going on. And I think that helped a lot in alleviating a lot of people's concern. So when we ungated the funds, and be it we did it in a limited fashion because we didn't know, what we were up against, we saw a huge pause in activity, because people said, you know what, I get it, things are strong, I'm getting my income, and as long as you're saying my distributions are safe, I'm happy. And I think I know you can be in business for 22 years, it doesn't matter. As long as once we paid out our April, May, and June distribution, I think it got real for investors that this wasn't as big an issue for us as they had thought it was. And so that was the decision then to reopen the funds. The decision to reopen the funds, we're saying, do we have confidence in our portfolio? Yes. Do we understand our investor sentiment? That was harder, but yes, I think we do. Can we take one-time shocks? Yes. And today, it's amazing to see, we're completely open, and quite frankly, we're quite healthy cash positions across all our funds. And in addition, Bob, we've also started to see very strong capital inflows, something that had stopped again in March and April. Again, I wouldn't fault any investor. No one wanted to invest in anything in March and April, but we start to see that capital inflow back to where we were even in 18 and 19, where we had very robust capital inflows, and that shows the confidence people have in what we're doing. And I think that's two reasons for that. One is, as I said earlier, low interest are here to stay. Get 7 or 8% on something that is quite stable. And two is, I think the story that real estate is very, very strong, and specifically in areas we're in. I think that we can prove in every metric and every number we put out there. So I think those two coupled together has led to a very healthy capital raising environment for us.
So Vikram, we have a few questions from some of our advisors, some of our wealth advisors here at Portfolio Stewards. And Andrew Bryden, one of our advisors, asked, he said, I've met families who have syndicated mortgage funds in Canada whereby they will never receive their capital back. Primarily, these are second and third mortgages. Can you elaborate further on how Trez Capital is different in regard to the risk aspect, collateral and loan to value differentiation?
Oh, Paul, sorry, Bob, that's, my pet peeve has been the syndicated mortgage space for years. A syndicated mortgage, I've always said, should not have the term mortgage next to it. It's not a mortgage. It's almost ownership and title of the actual property itself. It usually is second or third, as you pointed out, behind a bank finance or a bank finance or another private lender like ourselves. And then the thing about it, Bob, is we are investment managers. We treat a mortgage fund like an investment, right? It is a diversified basket. A syndicated mortgage is treated just like that. It's one real estate investment. Any one real estate investment can go wrong, and the longevity of it is not known. So you are in a syndicated mortgage. You're in one mortgage. You think you're getting, and because it's mortgage, and Paul and Bob, you know this. When you're regulated under just a mortgage, you can say anything. Like you can say things like guaranteed returns. You can say, there's no risk because it's not under a security or an investment, which is what our fund really is. So first bit of differentiator is the style of investing. You are invested in an investment at Trez in a diversified basket of mortgages underwritten by Trez, where we put the investor first. In a syndicated mortgage, that's not necessarily true. The syndicator is out for themselves, and the investors pretty much have to fend for themselves. If anything goes wrong, there's no one in between the syndicator of the mortgage and the investor to hold the investor's belief. And that has been the number one downfall of these syndicated mortgages. But most importantly, investors have to understand, Trez was a pioneer of the mortgage fund, the diversified mortgage fund. Why? Because any one mortgage in our space can go wrong. Any one loan can go wrong. We are lending in a high interest rate environment where we are dealing with people that can execute, but anything can happen. COVID can happen, a financial crisis can happen, weather issues can happen. So it's about being in a diversified basket. And sometimes people get caught up in these syndicated mortgages because they like the bricks and mortar. They think that they have someone on their side who's selling them the syndicated mortgage. That's not necessarily that's not necessarily true. And where it gets, there's two things that has flabbergasted me about the syndicated mortgage rate. One is how people put syndicated mortgage capital. We've seen Globe and Mail articles about people who've received their severance package from companies and put 100% into one syndicate. That I don't think you or Paul would ever tell any investor to put 100% of their money with Trez. I correct me if I'm wrong, right? I think you look at it from a diversified look point. The other thing is clients' lack of understanding of how risky it is to be in one investment in that space and how illiquid it can be if things go wrong. We've been in bad mortgages, and it's taken us 4, 5, 6 years sometimes to get out of them. But you won't know it as the investor because you're in a diversified mortgage pool. So, and then finally, it's about being with an investment manager, what we like to call, we're portfolio managers, not unlike Paul, but we're restricted to mortgages, not like portfolio insurers, but we're where we're restricted to mortgages, but we look at it as investment. And again, even our gating this year, we've proven it's all about the investors first. And we are on the investor side of the table, not the lenders, not the borrower side of the table.
Okay, perfect. Diversification is always our friend. Quick question from wealth advisor Haley Thomas. With interest rates at such low levels, will borrowers be willing to continue paying higher rates through Trez? And part two, I see on your website that the fund has a target return of 6%. Is that feasible going forward? Just a quick response on that, please.
For sure, and great question from Haley, because that is the question du jour. We think, and I sort of alluded to this earlier, we think in the short term, and the short term being any loans we do now into maybe April, we will still be able to get our regular rates, because while we're doing well, a lot of private lenders have struggled. A lot of the U.S. lenders, for your clients who are in the U.S. fund, a lot of the U.S. lenders have not done very well. So because we have capital and there is a demand for our capital, we will still be able to maintain those rates. The question really is, we are in a spread business. We can only get so much blood out of a rock. And so to Haley's question, can we maintain, and the target return on the U.S. fund, I think she was talking about yield trust, but the target return on a regular, is a little bit north of 7. In that regard, time will tell if we can maintain those. We'll maintain those distributions. We are evaluating that. We'll see what the market looks like post-vaccine, and everyone is back at it, and everyone is lending, and the banks are lending. But for all your investors to know, we don't chase yield. That is not our number one goal, is to maintain a certain target distribution. Our number one goal is capital preservation. Our number one goal is to keep our defaults really low and take what the market will invariably give us. And look, if that ends up being 6% or 5 and above in a zero interest rate environment, but we are maintaining capital and we're giving an adequate spread of what you can get in a risk-free or other investments, then that's what we'll end up doing. Next year, we think we'll maintain the same distribution, but we have no visibility into anything beyond that, because again, we're short-term lenders, so we only look out, for about 2 years maximum.
Okay, so that's perfect. And Vikram, thanks for your time today.
Thank you, Paul. Thank you, Bob.
Whether you are viewing this as a recorded webinar or listening to it as a podcast, thanks for listening. Smart investors do their research before making investments, as ultimately it's your money and you need to invest wisely. We realize that many of you hire us as a discretionary manager, and we truly appreciate the faith and trust that you put in us. But discretionary doesn't mean that we get to do what we want, when we want to do it, and simply keep you in the dark. We need to understand your plan, your strategies, and have a basic understanding of your investments and how the combination will help you to achieve your goals. There's an old saying, a great client challenges us to always position their portfolio for success within their risk parameters. Now, actually, I just made that up, but that's what we believe here at Wealth and Portfolio Stewards. If you have any questions or suggestions for future topics, we'd love to hear from you. Send us an email at info@wealthstewards.ca. That's STEWARDS, or visit our website at www.wealthstewards.ca or www.portfoliostewards.ca. If you enjoy this podcast and would like to be notified regarding future episodes, please subscribe on the podcast player of your choice. If you're listening to us on YouTube, you can subscribe to that channel. On behalf of Paul and Vikram, I'm Bob Simpson. Thanks for tuning in, and always remember, be careful out there.